deep dive. Today we're looking at six really critical snapshots of the global financial scene. We want to find the truth sort of hiding between the market buzz and, well, the underlying risks.
Exactly. Our mission for you is to connect these dots, from these really strong corporate profits to maybe some hidden stress in the credit system and figure out if this resilience we're seeing is built on solid ground or maybe something shakier.
Okay, let's dive right in then. First up, source one, corporate resilience. And the paradox here is kind of stunning, isn't it? Despite all the, tariffs, geopolitical stuff, corporate earnings are just soaring.
Yeah, it's pretty remarkable.
We're talking, what, 87% of the early results beating expectations, revenue up 6.3%, earnings climbing 9.2% year over year. That's significant.
It really is. And tech is, well, it's clearly the powerhouse here, driving about 34% of the S&P 500's growth. Financials help too, about 13%.
But not everyone's winning.
No, definitely not. Energy is actually a drag. Negative revenue growth there. But the big but, I guess, is that the market overall, it still looks really expensive, historically speaking, both absolute and relative terms. And that's feeding this anxiety about whether it can last.
Right, okay. So the C-suites are maybe happy, but what about the plumbing, the financial system itself? Let's look at the credit markets with source two. Dodge the bullet. We have seen some real stress signals, haven't we? Like those bankruptcies, Tricolor Auto, First Brands.
We have, and interestingly, regional banks that were involved in that loan chain, they've quietly tapped the Fed for liquidity, so they've, dodged the bullet publicly for now. But you look closely, and there are these subtle warnings, a drawdown in the leveraged loan market, for instance, and we're seeing spreads widen a bit on CCC bonds.
Okay, hang on for listeners. Widening spreads on CCC bonds. What does that really mean in simple terms?
Right, good question. It basically means it's getting more expensive for the riskiest companies. We're talking junk bond territory to borrow money. Investors want more compensation, a higher return for holding that riskier debt. It's a classic warning sign.
Got it.
Now, the big hope, or maybe expectation, is that the Fed's going to cut rates next week. And that's seen as, well, potentially massive relief for this whole credit world.
Okay, which brings us neatly to source three, fragility. Because that comparison it draws to the 1987 crash, that's genuinely unnerving, a 22.6% drop in one day.
It is. And the parallels they point out, market frothiness, geopolitical tensions simmering, low liquidity sound familiar.
Very.
And it's the scale of leverage today that should really grab you. Margin debt borrowing to buy stocks hitting, what, $1.13 trillion, new highs, plus another, say, $200 billion in those leveraged ETFs.
Wow. And this links directly to Nassim Nicholas Taleb's concept of market fragility, right?
Exactly. Fragility, in his terms, means the system is vulnerable because it's also interconnected, maybe too optimized, and it's packed with hidden risks just waiting for something to set them off.
And you could argue we're seeing signs of that now.
You could definitely argue that. It feels like we're ticking a lot of those boxes. And just to give you a sense of scale here, let's look at source 4. Gold versus the world. Think about all the gold ever mined, right? Its total value is maybe around $30 trillion now.
Right.
Now, compare that to global debt. That's sitting at roughly $340 trillion, and the global stock market cap, about $145 trillion.
Whoa. So the point is gold backs what? Like 6% of all that combined debt and equity value?
Exactly. Just 6%. It's tiny in comparison. Even if you throw in the entire crypto market, maybe $2.5 trillion, it barely moves the needle. It just highlights how incredibly leveraged the whole global system is relative to traditional safe assets.
It's a staggering difference. Okay, next up, source 5, inflation revisited. This one digs into the upcoming CPI release. And there are these worries about, well, how accurate the calculation even is. They mentioned the BLS being understaffed, having to guess some prices.
Right, the potential margin of error. But the fascinating point they make is that the accuracy might not even be the deciding factor for the Fed right now.
How so?
Well, the pressure on the Fed to cut interest rates is just immense. So the argument goes they'll likely lean towards their other mandate supporting employment, even if inflation does tick up a bit.
Ah, the dual mandate balancing act.
Precisely. And they kind of have this out because, yeah, tariffs are pushing up prices on some imported goods, but you've got these strong deflationary forces from things like AI pulling prices down elsewhere. It gives them, let's say, the political cover they might need to cut.
Interesting dynamic. Okay, finally, source 6, no growth. This flags the IMF projection for advanced economies.
Yeah.
And it's pretty weak, isn't it? Just 1.6% growth expected.
Anemic is the word, yeah. And This lack of real organic activity ties into another alarming stat, particularly for the U.S. It takes about $5 of new debt now to generate just $1 of GDP growth.
$5 of debt for $1 of growth. That just feels fundamentally unsustainable.
It does, and it begs the question, if the global economy, especially advanced economies, isn't really growing much, how are these big multinational corporations supposed to deliver the double-digit growth the stock market seems to expect?
Right. And the source adds that even the IMF doesn't see AI providing a significant boost to global growth until maybe 2026. So no quick fix there either.
Not in the immediate future, no.
Okay, so let's try to wrap this up for you. We've
Okay.
got this picture of high-flying corporate performance and market optimism, almost euphoria.
Right, butting right up against massive leverage, worrying parallels to past crashes like '87, real stress showing in parts of the credit market, and this backdrop of fundamentally low global growth.
It's quite the contradiction.
It really is.
Yeah.
And it leaves you with a pretty provocative thought to consider. Global debt is $340 trillion. Historically, you'd need much higher inflation than we have now to effectively shrink that debt's real value over time.
Mm-hmm.
But central banks are under huge pressure to cut rates, not raise them to fight inflation. So the question is, how long can this balancing act possibly last? How sustainable is an environment where you have both this potential credit fragility and this kind of intense market optimism coexisting?